All right. Good morning, everybody. It's Friday. The UK is down the most, more than a half, more than a quarter, but under a half. The NASDAQ up a dime. Everything else is flat. It's going to be one of those days. So far, everything is sideways ranged. Uh, if you've been keeping up with Spot Gamma, this is their thesis that we're going to hold into OPEX today without really selling off or rallying up any higher. We do have another Fed speaker. And we were talking yesterday about my phrase, watch the clock. Somebody said, well, I don't see any economic indicators at noon or 1, whenever it was I had made the comment. Watch the clock. If you notice in the morning briefing, we go to different places. This is Market Watch, and we're looking at Friday to see what they have on the calendar. Market Watch doesn't have any other country, just the US. So a glaringly obvious blind spot where we could have economic data, but we wouldn't know it because they don't even look. Then we go to FX Street. Now, FX Street does a really good job of looking around the world. So we have other nations here, but they still don't have everything. It's missing a lot of the commodity stuff, like on the agricultural side. And make no mistake, at some point, any data point can move the markets. So it might show as a yellow, or it may not be on the list at all, but it can still move the markets. Look at how many different economic events that we have on the table today. And very likely most of these won't matter, but we're never 100% sure. And this still isn't all of them. So we can see we do have a few Fed speakers today, multiple speakers speaking at the same time. That's going to be a big deal. And then we go to Finance Juice. Now, Finance Juice is a news aggregate website. The other places, they write their own content. They hire writers, they publish articles, they do their own work. Finance Juice gets those articles from different places and brings it to it. And it does a really good job of capturing new stuff. Say a Fed speaker yesterday decided they were going to speak today. That's really short notice. It would very likely be on Finance Juice, but not the others. It also has earnings. It does global events. It has built-in order flow. And there's audio, so you can run Squawk, which just means it reads these highlights or alerts so that you don't have to sit there staring at it all day. And even this isn't all of it. There's more economic events than this. One of the biggest ones that never shows up anywhere and absolutely moves markets every single time it shows up. Every time. There's never been an event where it didn't move the market. And that one is QRA. And it's a two-part event. It happens quarterly on a Monday and then on Wednesday. It's two pieces. And that never, ever gets listed in here. And it's a big one. How many others don't get listed in here, but happen quarterly, maybe even monthly? So watch the clock. It's easy to do. It doesn't cost you anything. You don't even have to buy something. Watch the clock. Look at volume. Go to a one day chart put it on a 1 minute, go back in the past and look at volume on every half hour and every new hour. You're very likely going to see an uptick in volume. Look at every change of direction. And very often you're going to notice that we bottomed out and changed direction, or topped out and changed direction after a new hour or a new half hour. Watch the clock. We're hearing more stimulus talk out of China from this housing crisis that's been going on for a couple of years now. China's slowly changed its tune. You know, at first they were just like, it's your mess, you clean it up, not my circus. But a little at a time, they're coming around to helping out. I think the concern here is that they keep trying other stimulus and it's just not moving the needle. So now they're trying something else. You know that it's not far off the mark. There are a lot of mechanical strategies that focus on concepts just like that. And there's been a lot of research over the years, not for an hourly, but for a daily. And when I first came across it, it was actually a publication from TD Ameritrade from like 2000 and somewhere in the 2000s, 2002, 2005, something like that. It was a pretty old article. And they were asking the question, if you bought SPY before the close and sold it at the open, would you do better than if you bought SPY at the open and then sold it before the close? Those kind of questions are always being back tested and analyzed and researched. You'd be surprised how effective some of those mechanical strategies could be. That's back before they had more sophisticated algorithms than they do now. But still, you're not far off the mark. It is a pretty light schedule today from the ones that we can see. And I don't expect much fireworks. Just keep in mind when there are Fed speakers talking that they can say something they didn't mean to say. They can say something that got taken out of context, and they can just straight up be misinterpreted, misquoted. So there's always this room for error, kind of like going to a NASCAR race, not because you're really interested in who's going to drive the fastest. You just really want to see a wreck. Keeping track of who's speaking today and being mindful of what they're talking about is kind of like that. I'm not really interested in what they got to say because they're not going to change policy. They're not going to really say anything that, is going to be outside the norm. They don't want to shock and awe or move the markets. But that doesn't mean that it won't be a train wreck or that they won't just put foot to mouth and screw up. There's been numerous examples throughout history where they've done that. The volume is looking good this morning, sitting at 63. The problem I have with volume this morning, sitting at 63, while we have this market maker move, is that today is OPEX. And I get it. If you're newer to trading, you may have come across some articles or you've heard something about OPEX, and it may seem like this mythical risk threat just hovering over the market today. It's not really a big deal. This isn't one of the big OPEX events. It's big enough, and it does have context. It does have weight. It does matter, but it's not that bad. So it's options expiration on the monthly. And because of that, we're seeing some volumes that is triggering the market maker move up here. Normally, when we would see that, we would say, oh, hey, watch out. They're hedging. They must be worried about something. They're spending money to protect their position. What are they scared of? And then we would need to go looking around and try to find it. But these tools, they're blind. They're ignorant. The tool can only see what we point it towards, right? It's looking at that one tree in the forest. So when a tool like the market maker move lights up, we can't take that on face value. We got to go in and ask, why is it lighting up? We can see that there's trading activity in the front end. But I'll stipulate and argue that this trading activity isn't necessarily for protection. They're not hedging per se. They're just rolling out positions. If we're unsure about that statement, because maybe I'm wrong, right? It's been known to happen. If we're unsure, then we could treat it as if they are hedging and we could approach with caution. Generally, when I approach with caution, I just reduce my position size. Instead of trading with 8 contracts, maybe I trade with 4 or 2. It's not like I'm going to miss out on something. So we can see that the hedging signal has been triggered. I'm going to argue that they're not really hedging, that they're rolling. But even if they are hedging, we don't really have to do anything. We just need to, be more cautious. That's it. The call wall hasn't been moved. It's pretty obvious. It stayed in place. Now, depending on who you use for your options levels, there's another 0-day call wall at 53.50. We almost hit it yesterday because it was there yesterday too. It's in the same spot today. So if we do get to the ADR half up at the top, 53.47, and we get through it, we've got a voodoo line here at 53.49, and we have a call wall there at 53.50. Now, I don't need a bunch of different option providers to tell me that 53.50 was very likely an options level. It's a big round number. It's going to be an options level. But it's always nice to have validation, right? That I don't have to just assume it's an options level. So we've got a really sideways market. We're basically where we're opened after a whole night of doing nothing. And we have no edge or insight into, are we going to go up and hit the upper red line, or are we going to go down and hit the lower red line? Generally, we're going to hit at least one of those. Sometimes we'll hit both of those. I know it may seem, a little odd, but that's the market. If we hit one of those red lines early enough in the day, we could flip around and go and hit the other red line by the end of the day. So at this point, everything's on the table. The only problem is half the trading day is already done. I know, I get it. If you're new to trading, you're thinking, what are you talking about? I just got here. Just woke up. But in a 23-hour trading cycle, we're past the halfway point. So it's all down here from here into the end of the day. I found that it's easier if we just go out to a chart with nothing on it to look at these pivot points and have a discussion for what it is that we're looking for today. So we can see that today's pivot is higher than yesterday's pivot. I didn't turn the channel on yet. We'll do that in a moment. We can see that the lines that go to each side of the pivot, the R levels and S levels, they're more narrow today. So even if I didn't have a central pivot channel indicator, I could just look at how much closer these lines are. It's showing a narrower channel. We're still inside day. We broke out of it momentarily, but came back in. And so far, it's an MDP because we haven't hit today's pivot. We also didn't hit yesterday's pivot, and we didn't hit Wednesday's pivot. The problem is Wednesday and Thursday, we were above the pivot. Today, we haven't hit the pivot and we're underneath it. It's going to act as a magnet, but so far, price has resisted doing that. That should be attention getting. That we haven't been able to get to that magnet because that's kind of a default thing. It's what we would expect price to do 80% of the time would be to go tag its pivot point. And it hasn't been able to do that. Now, it doesn't line up perfectly with this reversal back here. It doesn't, but it's close enough to just count that whole thing as a zone. And we're not looking at an S1 R2 scenario because we really have been holding this low relatively well, and we didn't get down to the S1. But like a good double bottom, which is a bear trap, we did get to the 111. What I highlighted here with the fib drawing was yesterday's RTH from the lowest point to the highest point, and then I turned on the 111. A really good double bottom will be a bear trap that actually gets bears thinking we're going to break down. So we don't want it to tag the line perfectly because that wouldn't convince any bears to get in. We need to break the previous line and go lower than the previous low so that we can convince someone to take a short. But when we start to get that breakdown, how do we know it's not actually just breaking down and it's going to continue to go? I mean, we never know for sure, but order flow can help out a lot. And so can measuring how far it should move if it's going to be a bear trap. And I like using the 111 for that. That number's not in the fib books, by the way. It's not like they promote 111. I came up with this as a halfway point between 100 and 123.6, and it's not perfect, but I like it. I call it my warning center. It's in the center between those two numbers, and it's usually a warning. Not very imaginative, but it works for me. Now we could have broke all the way down to the green line, which is the 1236, and still flipped and came back up. But if we'd have closed down on that green line and opened underneath it and then continued to go, at that point, there'd be no doubt in my mind that it's not a bear trap. It's actually a breakdown, and we're going to continue. And then we would just use the half, the 50% mark as our first target lower, and then 100% as our next target after that. So we flipped did a reasonably decent job of it. We've been coming back up, but it didn't do a very good job. We don't see a lot of trapped traders here getting squeezed and puking out their positions. We've got a higher high here from this high, but only into liquidity, and it was washed right back out again. Now we're trying to get through that same zone again, and we're getting washed right back out again. So got to look at the dome and look at how much more liquidity do we have here, because until we can work our way through that, or they move one or the other, we're not going to make it through this zone. And they're going to give up at some point. If they keep buying here and price continues to not rise, they'll dump it. Something to keep your eye on. So far, we've been looking at it just a pivot point. This is also just a pivot point, but it has the channel on it. We want to look at that channel and see, is it within yesterday's range at all? Is there any overlap? And if not, is it above it or below? We can see it's above. It's not overlapping at all. And then we want to look at, well, how narrow is the channel? We've got a channel back here. We could see it's a skinnier, more narrow channel. The more narrow the channel, the more likely we can trend. The wider the channel, the more likely we stay sideways and chop. The channels can be so narrow that you just see the purple line, that you don't even see the yellow lines at all. It can be that narrow. And it's not that narrow. So it's not crazy wide and it's not crazy narrow. So it's not helpful to us from, the point of view of, could this be a trend day or could it be a range day? That channel just isn't going to help us with that kind of information. Ten-day, 30-minute volume profile. We're going to lose more of this volume across the bottom. And so by Monday, when we come in, we should at least be looking at something like 5150. Throughout the week, next week, we'll be looking at around 5200. All of this predicated on the idea that we don't break out and continue to go higher, and or that we don't break down below 5200. We won't start moving the point of control until Thursday or Friday of next week, unless we build up enough volume at our current location to move that point of control. Usually, well, I don't even want to say it that way. Probably about half the time, the point of control moves because we took volume away from that location and it went to the next highest volume. But the other times it moves because where we're at now gets so much volume so fast that the point of control gets moved up to that new location. So it's something we'll be keeping an eye on through the week next week. If we stay up here and build out more volume, we'll expect that point of control to move up. We still don't really have a classic shape here. If I was going to argue for a shape, then I would say it's more of a classic D. But it's a really ugly D. And you're better off not trying to form fit. If it's not a clear, clean pattern, don't try to squint at it and decide it's a pattern anyways. Just acknowledge that there isn't one. We hit that VPOC yesterday, and it was only a day old, which is always awesome, because the older they get, the less value I really think they have. And we got what I call a first touch play on that. We came down and interacted with it, and we had a really nice reversal off of it. I don't trade those as levels blindly by themselves. But if you're watching the dome and you already know where that level is and you see price coming down towards that level, you can see all that activity on the dome. You can see all those participants at that level. Think about what that level represents. It was the previous day's largest trading volume happened at that price point. Out of anywhere else that they could have traded that day, it was where the greatest amount of volume took place. So it's an area of interest. We would want to know when we're going to hit it, right? So that one's done. We've hit it. It's no longer a VPOC, but we built a new one yesterday. So we'll just steal the line and bring it up and use it up here. If we do make a move to the upside, 53.32 is a cog line, and we've got the VPOC there. On this 5x5 chart, what I call mapping out the 5, having this volume profile and the TPO side by side really highlights how narrow our overnight range is. Make no mistake about it, we could sit right here and chop into the close. A 10-point range from 53.13 to 53.23-ish, right? Just that little 10 points there. We could stay there all the way to the close. I don't think we will, but we could. We have next week's range. It's not set in stone yet. It won't lock into place until 4:15 tonight. But even early, every Friday, we just get a feel for what next week's volatility looks like, because that's what this range represents at the end of the day, volatility. They're pricing in more volatility next week than they did for this week. That's interesting. What are they worried about? The biggest thing on the table next week is NVIDIA earnings and VIX expiration. Doesn't seem a reason that would warrant an increased volatility like this. Bigger than CPI, EPI, and PAL? I don't necessarily agree with that, but that's what we have. So it doesn't matter if I like it. After the end of the day today, you can go in and, check it again, just like I did. We'll be looking at it on Monday. So we'll reevaluate at that point. We're still outside the box for this week, and we're supposed to close underneath this green line 8 out of 10 times. Last week, we did not. It's very frequent recently for us to not close inside the box the way that we're supposed to. That's a signal of volatility. These 2 weeks, back to back, we closed outside the box. And then this week, it's 3 in a row where we closed outside the box. And last week, this week isn't closed yet, so we won't count it. But there's 1, 2, 3, 4. We could keep going. We only need to count 10 weeks. but we've already got 4 closes. That's way more than we should have. I can do better than that flipping a coin. This is how we know we don't want to trade iron condors right now. And we don't want to trade strategies that put price in a box. Now, Spot Gamma says that we should pin between 53.20 and 5300. So that's for today's expiration. We can work with that, but we still don't want to do like the weekly expected move play and the weekly butterflies or the weekly iron condors. Not yet. We're still breaking this box too much. We're closer to the 10-day moving average again, back within our normal range. We did get up, pretty close to 2%, but we faded off from there. And if we look at what we have done on the year, all the way back to January, the average is about 1.5%. We're underneath that. So we're not overbought. It's not due for a pullback. We haven't traveled too far too fast. And on the week, we're 2.7% away from the 10-week. And when we look back what we've done on the year, we generally hold above 2%. So we're not even near our optimal range yet on how far we could continue to expand to the upside. We have the dollar index up this morning. We have the 10-year up this morning. So we want to keep our eye on those and see if they're going to continue to move to the upside or if they're going to break that white line, that 3-day moving average, and retest yesterday's lows. We don't really want to see these make any fast moves up or down, just some casual grind in one direction or another. Nothing swift or extreme. We can see that once the dollar topped out this morning, the dollar index, we started to get that reversal in the S&P and the NASDAQ. Now, notice it's like a V shape on the NASDAQ and the S&P, but on the dollar, it just flattened out. It really, it didn't fall back per se. It just started building that topping pattern. And I highlight this to show we're not looking for a tit for tat teeter totter thing where the dollar goes down and the S&P goes up, or the dollar goes up and the S&P goes down. I love it when we get that, but that's not what this is. The dollar continuing to work its way higher put pressure on the S&P and the NASDAQ and swaying them down. When that dollar started to signal it wasn't going to continue to grind higher, the S&P and the NASDAQ immediately responded to that. We V-bottomed. So keep your eye on the dollar and the 10-year today. If they begin to signal a bullish behavior and looks like they want to continue, it's very likely the S&P and the NASDAQ are going to respond to that as well in a negative way. If the dollar and the yields do back off and just hold the range and quit trying to rise, that'd be a good start. But actually give some good bearish signals that they're going to start to break down a little bit. That helped the S&P and the NASDAQ. All right, these might look like daily candles, but they're not. They're 12-hour candles. This is a thinkorswim trick. The reason I'm doing that, on thinkorswim, if you're looking at an equity product, say Apple, and you go to a daily chart and it's not yet 9:30, the daily chart won't show you that pre-market trading activity. We can see the bid and the ask on Apple really isn't far away from where it closed last night. But Meta's off by $1.50 or so, maybe $2. But we're not seeing it here. It still shows the close 473.23, 473.23. We're not seeing that bid and ask. We're not seeing any pre-market move. This is my grump with thinkorswim on this. TradingView shows you pre-market, even if it's just a line, right, on the daily chart. TrendSpider actually just shows you the daily candle in the pre-market. So other places do it. On thinkorswim, you can kind of cheat and do it too. Just use 12-hour candles. It's technically an intraday candle because it's an hourly candle. It just happens to be 12 hours, which golly gee gosh, that's a trading day. That'll work. You'll notice sometimes a few little odd quirks when you do this, but it's only to get you into the open anyways, because after 9:30, you'll have that candle showing up on a daily chart anyways, and it won't matter. So it's just useful for the pre-market. Tesla's wound up in a reasonably decent range. And I would look to come out of that hourly candle, break out above 176 for a run into 180, and then we'll see if we can get through 182 and or break down below this 171.5. There's your plus and minus right there, right? Simple enough. Apple, same thing. We got this bar of control. Half back needs to hold, which happens to also be that 10-period moving average. We're underneath that white line, which is a 3-period. We've seen a lot of defense here. They're coming in to buy it up along this low. So we want to see that buying defense continue to hold. If it doesn't, they might wash it back to the halfback, that 188.76, get a nice bounce there for some momentum and then run it back up. If we continue to fade through the 188, then it's a nice short down to 187, but I'm not bearish Apple in the bigger picture, so that would just be a short-term short. Google also with a nice compression inside of this bar. This is IX10, but can't get excited about IX10 when it's a wide bar like that. So we're holding the halfback. If that fails, then we'll run it to the 10 down here, this 171.8068. Call it 172, I guess. It's a 10-period moving average. Otherwise, let's get to the top, break that 175 and get a nice continuation. There's no reason to believe that we're going to get any kind of continuation today. But if we do, then we got a plan for it. It's more likely that you'll see a breakout and a continuation in the equities, even if you don't get it in the indexes today. Amazon's a mess. Consistent, persistent move to the downside. If we were going to get a surge signal, then price needs to get through both these moving averages, and then we need the white line to cross the blue line. We can use yesterday as our candle of concern, which gets us that 184.5, but this bigger one is really the one in control. That's 185.5. Netflix is a mess. Nothing here. Any sort of rally has to get through all of this trash, all of this mess. And look at the wicks first, just across the top. There's a lot of defense. Every time we get above, say, 615, they're selling the heck out of it. Now, sure, that if we look at the other wicks, they are defending it along that low, along that 610. When we get below 610, they're buying it back up. But that's a lot of selling at different levels. So Netflix is just a mess. NVIDIA had that nice expansion yesterday. It needs to hold the hat back. This little bit of a fade this morning isn't enough yet. It'd be good to tag that 10, get that 928 bounce. And then PayPal, we're trapped on the underside of this hat back. This is the bar of concern, and we're above that, right? That midpoint. So holding above 64 gives us a chance to test that 64.50 hat back. And if we can get through that, then we can check on 65.5. But this is a mess. This is nasty. And when we ran up and tried to break out, they sold that sucker right back off through 90, through 65, this level right here. We broke out and just got smacked down. So we don't know if that buying and if that selling is done yet. That's the fear. If we do get back up there, that they're very likely still waiting with a more to sell and that it's not done. All right, so what's up this morning? Nat gas, Bitcoin, gold miners. We don't want a rally sustained on Bitcoin and gold miners and nat gas. So Baba's up this morning. It's a part of the China ADRs. Baidu was up, but it broke down, closed the gap. BDD, inside day breakout, still holding the break. JD was up, but gave it back. Never even made it outside of yesterday's range. So kind of a mixed bag on the China ADRs. And there was some pot news. It wasn't really news. It was just attention by the president yesterday. Some comments made in the pot stock space, so they got a little bit of love, and they're still up this morning. But it isn't getting anywhere, right? It's up a little, but we're still inside day. So let's get that inside day breakout. Then we can challenge something around that $485 area. Same thing with this other pot ETF, MSOS. It's up, but there's so much trash overhead that we wouldn't really even want to mess with it. So we got pot stocks, Bitcoin space. So things like Riot, Mara, they're both up, but not very much. MSTR, nice gap up in that. This is an odd continuation signal. First, we do have that inverse head and shoulders, which I'm not overly excited about. And if we measured it, we've already made the first measured move. The textbooks will tell you measure that neckline break or measure this and then plot that this way. Half of that move would be the warning. That'd be your layup, your easy run. And then all of that move would be 100% of the move. We've already made enough of it that it doesn't owe us more. Then we can measure this, the breakout bar. That's the neckline break where we actually made the move, the travel. We can measure that bar, mark its halfway point. And it fell back, but it didn't get underneath that. And now we're gapped up this morning. And so we can measure that red candle and get its half back. We've already gapped up near the halfway point. There it is. We can see it on the intraday over here. So kind of want to hold that. And then coin, which sold off hard yesterday. None of the others really had that move. It's up a little bit this morning, but this thing is toast. It's got these two really big bars to deal with. Got a lot of trash, a lot of drama. So even if this rally does try to continue, it's got so much work to do that I wouldn't use this one. If you're going to trade the Bitcoin proxies, I'd find something else today other than coin. Silver's up this morning. We got the inside day breakout attempt. Looks like it's holding just barely. Now, if you don't want to play just SLV, silver, you can open up like silver ETFs and see if there's any companies inside of that you might want to play. Because I get it, silver is not necessarily all that exciting. Just like I talked about a double bottom earlier, and that 111 being a reversal and a good way to spot when we had a bear trap, a double top, we can do the same thing. We can lay a fib on it, mark out that 111, and see how price responds there. Now, the fact that we have this red bar by itself, that's not enough to say that we're rejecting here and that we've got a bull trap set up, a double top, and we're going to run it back down. That bar is not enough, because if it's a breakout and the first candle pauses, then we get the second candle and it didn't just fall all the way back down. So it wasn't like a fake breakout fast failure, right? It didn't just pop up and drop. Getting back below the line, it didn't do that. It broke out and stopped. We can mark that halfway point and see, is it holding above the line or not, that halfback line. And then we can carry our expectations for this next thing. It needs to hold above this halfway point. If it continues to hold above this halfway point, then that breakout is still valid. We'll expect a little bit of pullback, and then a continuation to the green line. If it gets back below this 50% mark, then we're going to target the breakout point. And if we get below that, we're going to target this gap fill. It's 52.50. But we don't have any reason to believe we're going to do that kind of sell-off. If we were to back it all up to a blue sky event that we had here, sideways range, there's a big breakout, and then a really big gap up, and it needed to digest all that, so we faded down at the halfway point here. It didn't get below it. So we want to let this play out, right? I want to let this see how it's all going to come together. That 52.87.5 is an area that we want to pay particular attention to on this breakout. I don't see any reason for us to sell off and see 5,100, 5,000, 49.50. But we could easily stall out here and have a dud for the quarter. I don't know. Would it really be a dud though? I mean, we had a nice recovery back up. We had QRA in May here. The next one is August. It's a long ways between now and August, right? And since that QRA, we've made it back to the top. So we could just chop here, hold the line, stay healthy, and not dump back down. So I think over the weekend, I'm going to look for reasons to continue this move. It's not going to be what we got on the chart here, right? It's going to have to come from somewhere else. But there's nothing bearish in this right now. There's really just nothing bullish either after that good run up. We need something more than that. We're already through all the major earnings. It looks like it might be a boring day. Just holding the line, watching the options flow come through. It might be just, one of those days. But I'm going to add this right at the end here. Keep in mind that on an OPEX day where we normally would pin, it'd be very common to pin. And by pinning, if you haven't heard that phrase, it means literally we're just going to stay in one spot. We're going to stick or pin to an options level, 5,300, 5,325, 5,350. It'll be something like that, right? Well, we closed at 5,300 basically last night on the SPX. So it could just stick there and not move. But I've seen OPEX days where it's another one of those runners where we go and go and go. And it's like by noon, you're thinking, man, that's been a heck of a run. There's no way we're going to continue to go. And then it just keeps going and going and going. I've seen that on OPEX before. It's not as common, but it does happen. So my base case argument, we're going to go sideways. We're going to hold the lines, get into the weekend. But if we start to run, mark those 50% marks and just keep track of the ADRs because that's what we'll go to, right? ADR high, ADR low. And I continue to say it, there's a difference between a range day and a sideways day. They're not the same thing. If this is going to be chopping into the close today, if we're done, then it's going to be the kind of day that is just sloppy price action. Everybody have a good weekend, and I will see you all next week.